further ado, we'll welcome Juan that will introduce us to Darwinex. So the floor is yours, Juan.
Well, thank you, Gautier, and for this very kind introduction, and on generally congratulations on the meetups, and also thank you to all the attendees. I know it's getting late, even though Gautier told me that the work days go into very late in Hong Kong, but it's I really appreciate the opportunity to speak to you. So yeah, there we go. I'm going to start sharing my screen as I prepare a presentation for you guys.
So which questions, maybe you can write the questions in the chat, and we may go through at the end of the presentation.
Yeah. Okay. Fantastic. Yeah. So tiny bit about me. I'm one of the co-founders of this company, together with my brother. I'm very pleased to be speaking 10 years to our target audience. It's been quite a journey. So some background on us as a company. As I said, founded 10 years ago, 2012. Be fair. We currently employ 60 employees. We're in.
Right.
Okay, so it's back. So we are, in addition to being a fintech, we're actually deep in the regulated end, because part of the service we extend, as you'll see, requires that. We are very proud to have clients in 60 countries, so it's a pretty international endeavor. And there's a very important point that I'm not sure everybody will appreciate, but I still want to make. We are a company that's funded organically, meaning we pay for these 60 developers and our product out of the revenues we've got as a company. And I'm saying that because for me, it's been very sad to see very promising companies, also especially in the quant field, which were VC backed, basically have the plug pulled on them and disappear, leaving behind a fantastic community. So I guess what I can say is we're here for the long haul, and we have the means to keep up. So with all that said, meet Charles Darwin. I guess one of the questions you had is, why on earth are these guys called Darwinex? And you probably know Charles Darwin in the context of natural selection. He was obviously the first person to theorize and prove that it existed. And then I guess the next question is, fantastic, we know Charles Darwin. What's it got to do with machine learning, quants, and asset management? So over the next, I guess, 20 minutes, I'll try to explain that for you guys. So the structure of the talk is, I've already told you a bit of Darwinex. I'm going to make a couple of bold claims at the beginning of the talk, and hopefully walk you through why I think it's justified to make these bold claims. As I do that, we're going to intermingle some demos of our platform, so you can actually see the whole thing for real. And at the end of it, as I've left up quite a bit of time for a Q&A. As Gautier suggested, I'm not even sure how to see the questions, like the chat thing as it comes up. But if you make some questions, I'm sure it'll show up somewhere, or you just Gautier, you interrupt me.
Okay. Yeah, don't worry, we'll go through them together at the end of your talk.
Okay, so okay, let's go for it. So the reason we use Charles Darwin as our mantra is because our feeling is that asset management needs natural selection, and I shall argue the process of natural selection is not complete at this time. And it's not because we're still living in a paradigm, namely collective investing, which is an industrial age paradigm, in the sense that you can have a 4T any color you want it, as long as it's black, right? And collective investing, in a way, is an industrial age legacy. So you have this big cost of hiring the experts. So what you do is you pool investor capital to be able to pay for the infrastructure. That, of course, comes at the expense of choice, in the sense that, there's a fund that you can buy that fund, that you cannot buy it, but you cannot really personalize it to your liking. And it certainly doesn't reflect the fact that over the last 15 years, with the advent of fintech, the cost of infrastructure has essentially disappeared. So the need for collective investing, arguably, is less so than today. So what we do to counter or to introduce this innovation is level the playing field for producers and seekers. And by the way, I'll be talking the process, like for me, a producer is a manager. It could be a machine learning enthusiast who applies his algos to producing strategies that produce alpha. So I'll use these terms of alpha producer, machine learner, manager, trader interchangeably. And I hope you'll forgive me for that. But I also hope that I've made myself clear on that one. So we level the playing field so that everybody can enter and prove what they're worth. And we do so by indexing whatever machine learning strategies you come up with directly into investor brokerage accounts. And we do so by meeting regulation, which is very important because this is a regulated activity, and it might also require you to have regulated permissions. And very importantly, also protecting the producer IP. So if you've worked very hard to produce a machine learning algorithm, the last thing you want to do is to have someone steal that from you. And by doing this, we produce a asset management value chain, which is basically an asset, a producer or a quant or a machine learner who comes up with a strategy. He sells this strategy to an exchange. Thus the name Darwinex, the Darwin exchange, as I'll explain in a bit. And then this exchange then sells this directly to capital allocators, be they like professional one mainly, or actually even retail ones, because the platform is open to both. So that's going to be in a way the structure of my talk. But before we go into the details, let me just start with a watermelon producer. This guy is very proud that he's produced this watermelon. The analogy here is the fantastic machine learning strategy that you've produced that analyzes stocks or futures or what have you and has an edge. And this producer, he could be either an up-and-coming student who's coming up with these strategies, and he could manage his own capital, but that has a catch in the sense that if you just manage your own capital, then even 20% of a peanut is a peanut. So that's kind of an issue. And then eventually people who do that realize that either they go into third-party employment or they find some way of getting third-party capital. So let's assume they have decided to go into third-party employment, and already the problem starts. So the actual producer of the machine learning is making sense, and the factory keeps $1. And it's not like they're being selfish or anything. That the factory is carrying an overhead like technology, regulation, risk management, operations, possibly sales or business development, and this whole thing is actually quite expensive. So there's only so much they can share with the front office. Now, this asset manager typically doesn't have a lot of distribution. So behind that, there is some wholesaler that buys the strategies of the asset manager, who buys it off the producer, and he also needs a cut. And at the end of this value chain, I'm taking the generic value chain, you have some retailer who has to actually source the clients, and he also takes a cut. And by the end of this, what we've got is the poor investor who's paying this whole party, which actually goes to everyone but the guy who produces the alpha. Okay, so that's the problem we see. And why is that a problem? Well, just to summarize, so the access by the producers to the factory is constrained. Many of you guys are presumably born near the Hong Kong Financial Center, or maybe you've had to relocate from wherever you were born because you're smart cookies and you wanted to do this. I'm assuming like some of you guys are interested in finance, but how many people don't have that opportunity or don't even know that they might be able to do it? Okay, so that's already an uneven playing field. Now, this thing, in addition to constrained access, is complex. It's just like very hard to understand who's doing what and who's accounting for the $3 at the end of it. The fact that it's complex, it also makes it opaque. Like you don't really know. As I said, it's very hard to know, and but it's expensive, as we've seen, because there's all these middlemen who are in the kind of taking a cut. And also from the standpoint of the seekers, you have constrained choice in the sense that you only get to invest in whatever the retailer is offering you. So if you work for, if you're a customer of HSBC, to make an argument, then HSBC controls what kind of strategies they make available to you, and you don't really have the full choice. So how do we solve that? we actually work for the producers, and that's an important one. So unlike a lot of the companies in the space, we work for the watermelon producer, and our revenues are primarily from the watermelon producer, which means our loyalty is also with them. And the way the process works is we offer them a way to generate strategies on what's required to be liquid delta 1 assets, meaning you can trade equities, futures, FX, or even CFDs. And if you even had the stomach for that, you could even trade like the strategies of other strategy providers, as I'll show you with an API. The platforms that we currently support are Trader Workstation from Interactive Brokers, and MT4, MT5, and you can also trade, send your signals via FIX. So what we do those strategies is we actually exchange list them. I mean, this is I've taken the liberty to claim it's an exchange listing. Obviously, we're not an exchange in the way that you know it. But what we do is we create a platform that offers these assets as an investable index. To show you what that actually means, I'm just going to take a bit of a trip to our interface, which you hopefully see right now. Did the screen turn back?
Yeah, it's good. We can see Darwinex.
Okay, so we are in the Darwinex platform, and what we've got here is a manager whose name is Acu Global. He's a user of Darwinex. He can have a number of strategies. So he's got, in addition to this one, which I'll explain in a second, he's got another 3, which he is trading with prop capital by himself on the Interactive Brokers interface. And he's chosen to list this strategy for the benefit of third-party investors. And what we do with the strategy is we create a ticker for it, which is in this case ZVQ. But more importantly, we create a quote for it, which tracks the mark-to-market of the strategy since inception. So this is a strategy with quite a bit of track record. So you can see he started off at 100, then on the first month lost 1.04%. So he went down to 98 from 0.96. And if you keep going, eventually over these 10 years, he's accrued a cumulative performance for investors of 526%, which summarized in a quote blends into the 100% plus 525 means 625. Now, this quote is actually tradable because it's the mark-to-market of what the strategy is doing real time. As you can see here, the price will hopefully move because he's in the market right now. And if I was an investor or asset allocator, I could buy this strategy, meaning I could allocate or place the trades that this strategy is going on my own account without seeing them, because that's the way for the producer to protect his intellectual property. At the end of this process, what will happen, and I'll repeat this a couple of times so you internalize it, because we are an FCA regulated and EU regulated asset manager, we collect fees from the investor and we pay them out to the producer. Enough said at this stage. I've said that the first time. I just want to go back to the interface, to the presentation. So I've covered this point of strategies being exchange listed as these direct, meaning they're put directly into the investor account, risk weighted, which I'll explain in a second, investable indices, which we call Darwins in honor of our patron, Charles Darwin. And because we list them on the Darwin Exchange, well, that's the name. So I've explained the point about protecting producer IP. So a lot of people kind of put us in the category of mirror trading and social trading and a whole bunch of other things, which we're not, because we do not disclose the live trades to protect the IP. And then also we extend the regulatory umbrella of our FCA and EU license to collect the management and success fees from investors that you source or also we source for you. This risk-weighted element is the core of our innovation. And it's an algo that essentially manages the investor risk at arm's length from producers. So if you think of traditional hedge fund speak, you would be the front office. All you would see would be, in this case, the Interactive Brokers terminal, but there's a second layer in the background that's going to manage investor access to make you credible in terms of separation of duties. And that risk engine actually takes the role of the middle office. In addition providing the regulatory umbrella and the technology platform, we actually seed strategies with 45 million 6-month allocation every month. So if you're interested in looking at how that works, you can come into our website and see the guys who are leading this at this time. Hopefully, it's showing the rank ordering, right? So the first guy gets 360K. For a total of, I mean, potentially, since this is cumulative, if you win this for 6 months in a row, you benefit from a 2 million seed allocation, which is a way to start. Back to the presentation. So I'm just going to explain a quick what this risk engine does, starting from the point where you place your trade on Interactive Brokers, all the way until the investor backs your strategy on either a managed account with a Darwinex broker or a prime broker, or wrapped as an ISIN wrapper, such as UCITS fund or a RIFE fund in Luxembourg, and like the different wrappers that make you investable to the, for instance, institutional investors like ADIA. Now, how that works, since you're a technical audience, I'll just give you a brief overview of how that works. Let's take the strategy again. We can see the equity of the underlying strategy filtered for drawdowns, sorry, filtered for deposits and withdrawals. So this is the underlying equity curve that the trader achieved with their own capital. And what we do is, as on the first instance, we measure the value at risk with which the strategy provider is trading his own capital. In this case, it's a pretty low value at risk, say 1% per month. And actually, the value at risk, or the kind of the risk we have promised investors, is say 6.5% value at risk, which would be, give or take, the value at risk of the S&P 500. So what we do then is two things. The first one is we can gear up the risk of this investment or gear it down to meet any kind of investor value at risk. So for instance, I'll show you how that works for the same strategy. I just want you to keep track of the performance numbers achieved with a value at risk of 6.5%. So, starting with 10.04, 15.99, and so on. And I'm now going to go into like an interface that presents this for the benefit of the end investor. And for argument's sake, I'm just going to pick the value at risk at 6.5. So you see the performance here matches exactly what we saw for the 6.5% VAR, because I've precisely said that for it. But maybe Gautier here is actually a low risk investor and he doesn't want this. He wants this strategy because of its liquidity and lack of correlation as an alternative to cash. But this risk is way too much. So maybe we can take this one and scale it down to say 1.5%, and you're going to see that all these numbers are going to change, but the shape of the curve will not. Why is that? Because we've essentially scaled the risk to suit the risk appetite of Gautier's risk appetite. And this is what I meant by personalizing the investments. There's no such thing as equities are risky and bonds are not risky. There's such a thing as how much exposure to the underlying volatility of the equities do you want? Because thanks to this risk engine, which normalizes the risk, we achieve two things. One is we can personalize the risk for each investor, but also equally important, we are in a position to say that all the strategies in the platform have incurred in the same risk and therefore are comparable for return, which is very important from the standpoint of an investor, which is to say, from the standpoint of an investor, you can basically very quickly spot the guys who are doing well, because you come in to see this guy. Okay, if he's got a quote of 234, it's actually because he's delivered a good track record in terms of performance, or he's been around for quite some time. But it's not because he's taking more risk than the other guys. At this point, I mean, I don't know if there's any questions, because it might be a good point to take them. I don't want to miss the audience, because this is quite an important one.
Okay, well, so we got a couple of questions, so let's go through them together.
Okay.
All right. So first question is okay, maybe it's a bit naive, but let's ask it nonetheless. So can you short strategies, like you spot a strategies like
Yeah.
there's a structural break. Do you allow for that, or
yeah? So that's actually a very good point. So we've thought about it for quite some time, but there's a couple of difficulties. So one is obviously the quote for a long strategy isn't the same quote as a short strategy, because in one case you're paying the spread, and the other one you're paying the opposite of the spread. That's one point. But the biggest issue is that in order to provide liquidity, I mean, like, everybody wants to short a loser, right? that's the problem with that. And if everybody wants to short the loser, but there's only the loser backing himself, then there's a mismatch in terms of risk that someone would have to fill, and we don't want to take a market making role. So conceptually, it's really appealing, and we thought about it quite some time, but I don't think, at least we haven't come up with a way to do it in practice. But I don't think it's a naive question. It's actually a pretty smart question, to be honest.
Okay. Yeah, but as you say, there are lots of difficulties to implement that properly. Next question is, so actually many people ask some sort of the same ideas that, okay, you do delta one asset, but many quant strategies, they are involving, for example, options.
Yeah.
Or the new frontier of quant investing is like corporate bonds, for example. So
yeah.
Do you intend to add that to the platform at some point, or what are the difficulties to do that?
Okay, I mean, like, obviously, if the smart cookies are trading that, then we will try to support that in the long run, because it's part of the vision, right? If we're not trading if we can't offer the melons that the smart cookies want, then it's hard. But then, of course, it's a tough. I mean, this risk engine is already quite complex when it comes to delta one instruments. So I could see the bonds as an easier proposition as long as the bonds are liquid. So I can see, as a matter of fact, we already offer ETFs that are actually replicating bond portfolios. So that's in a way sort of already supported. The options with the Greeks and so on, I think that, and also the time expiry component and so on, that brings a whole set of quant as well as operational side difficulties that I don't think we're equipped to handle in the short term. Obviously, from our standpoint, what we need to do now is build the first success stories to attract the attention of the sort of investors who understand the value of what we're doing and take this to the next level. So the answer is, do we want to do it? Yes. Can we do it right now? No, because it's going to cost a ton of money. But hopefully with the support and the word of mouth of people like you guys, we will attract the attention of the right guys, and we'll be able to fund that investment.
Okay, clear.
That's
the question is, if you do the typical quant equity long short strategies, you end up with a relatively low vol. So what typically people they are doing is increasing leverage.
Yes.
So the related question is like, if there is like a matching of risk, if it's controlled, what's the amount of leverage you allow on the platform? Okay,
so that's again a very smart question. So let me go back to the interface and show you. I've shown you the measurement of value at risk. Now I'm going to show you if and when the strategy intervenes. So what we do. Can you guys hear me? Because I think the sound went. Yeah. So what we do is we plot. Let me actually show you that. I'm just going to do that for an FX strategy because that's actually easier to see and understand. What's going on? Yeah, I think my computer goes crazy when I'm presenting. So this is the underlying strategy in FX. And what we've got here, and we can even zoom this, these are the trades that the trader placed in like short some currency and also potentially long some currencies at some point. well, actually not in this period. I mean, you see he went long cable here. So what we look at is actually we reconstruct the mark-to-market volatility from the strategy provider's account on a minute-by-minute basis. So what this is saying here, and I need you to look at this part of the chart where my mouse cursor is. I hope you can see it. Can you see my mouse?
Yes,
it's where the green dot is. So what we're doing here is we're scaling the volatility of the account by the volatility of the anchor, which in the case of FX is the euro-dollar volatility. And we're saying this thing is 2 times as risky as this. Now, according to the historical pattern of risk-taking, which we measure in value at risk, we plot this exposure into position duration versus position volatility space. As long as this is within the range of tolerance, all that happens is a mapping of 1-to-1, or maybe like rescaling as part of this value at risk rescaling that I mentioned before. Now, if all of a sudden the guy who normally trades between 0.08 and 1.5 leverage, and he has like a fat finger mistake, or the algo goes crazy, what have you, and he goes into some positions that mean the account is like 50-to-1 levered, then the algo will intervene and only replicate for investors up to the amount that's allowed within that range. So, I've kind of talked a lot, but to come back to your question, yes, you could increase the leverage, but no, you cannot just increase the leverage in an unlimited way, because that would be more risk than the investor signed up for. Did that hopefully answer the question?
Yeah, to some level, but it's also related to a question, but maybe we should continue in the talk about from what kind of strategies do you nudge toward to? So you want more people do smart betas long only, or are there people that are more doing long shorts or even driven?
Yeah, I mean, honestly, I don't care which way you skin the cat, as long as you skin it.
All right.
So it's really about producing an edge for investors. And then there are tools that allow the investors to see what's the underlying basis of the strategy. So I mean, for once, I've shown you that we actually show the history of trades if the trader allows for it, so you can already see what assets they trade. There is things like showing correlation between this and both other strategies in the platform, because you could build portfolios out of these, and the main kind of the benchmark indices. And there's summary statistics as to what time frames is this trading. So for instance, I can read this as an algo because it's trading all day long. I can see what sort of assets they're trading. I can see the balance of longs and shorts. So let me just show you the one that shows that. So this is showing you for each of the assets what's the balance of long and shorts. So if it's long only, then you would see long only positions. If it's long and shorts, you'd see some symmetry across the position. So there's a fair amount of toolkit for a sophisticated investor to figure out what's going on, and then it's down to the investor to figure out whether he wants it or not. We are an exchange, and our job is to list the strategies on a level playing field.
So I've got one question here.
Okay.
So hi, it's Kome here.
Hi, Kome.
But so as I understand, Interactive Brokers has their own marketplace. They have this marketplace for anyone to basically put their own strategies on to market out to whoever wants to put it.
And nothing stops you from using that. Sorry, yeah, keep going.
Yeah, and obviously we've now sort of seen the, let's say the GameStop saga last year.
Yes.
With Robinhood traders, more retail investors getting involved. We've been talking more about the sort of the traders aspect, but maybe we have individuals here who might be interested in investing. Over the last, I would say, couple of years, I understand that there are loads of hedge funds here in Asia that are ramping up. They're looking for AUM. What do you think that this might be also a platform for hedge funds to, I guess, gather assets?
Deploy. Yeah.
or even deploy their strategies on your platform and to gather AUM in that aspect?
Yes, I mean, I think one of the downsides of a marketplace is that it's like a chicken and egg situation, in the sense that you only attract high quality producers when the AUM are there, and so alpha begets AUM. But also AUM begets alpha, right? That's kind of the chicken and egg situation. But the beauty of a marketplace approach is that any user can play any role. So you could be, say, a hedge fund who wants to monitor their traders, and that's kind of one use case that you could have. So what this allows you to do is, there's a backtesting simulation here for you to see, okay, what would have happened with a portfolio that had invested in the last 3 months in these strategies. You can even do that via API. I cleaned my cache, by the way, so it's not showing. Which is documented in GitHub and so there's an API to do this algorithmically, if that's what you wanted to do. I'm sure the smart cookies will want to do the shorts and so on, but like you can go on the long ones. So what is the use case here? So maybe you're a hedge fund and you've already got access to 6 strategies. Well, you can pipe those strategies into the platform. You can look for other third-party strategies that you like. You can then create a portfolio out of those.
Si vede che a che ora sei andato?
Sorry, I missed that. Hello?
No, I think it was a glitch. Someone that.
Okay. So basically, as a hedge fund, you could both introduce your strategies to benchmark them against other available strategies, then add third-party strategies, and then take that as a portfolio and then market that to investors. And all that you could do within this functionality. The hard bit, honestly, is for people to understand all that's possible with when you go for an exchange-like approach. Did I answer that one?
Yep. Thank you very much. Appreciate it. Thank you.
So yes, I mean, if you know any capital allocators who would be interested in this, or any hedge funds who would like to attract AUM, I mean, we're all up for it. And as I mentioned also at the beginning, this is not an exclusive platform, in the sense that, you know, you could be on the Interactive Brokers Investor Marketplace and you can also be on this one. At some point, as you scale the AUM, there could be execution issues. So, you know, it might be advisable to just choose one place to pipe the trades, and then also to come back on your point with like the Robinhood issues and the non-liquid stops, like with Reddit and so on. This is the reason why we restrict the choice to liquid instruments. So we wouldn't really have allowed trading of Reddit to the entire customer base. We might have done it for people that we've known for quite some time, that they know what they're doing. But, you know, having Reddit on our platform and all that happened there could have led to a lot of trouble for us, which is why we go for the liquid assets only. Okay. So an important aspect in many cases with machine learning quants is the intellectual property and fee flow. So the way this works is sorry, my animation went wrong here. So as a producer, you trade your own account with Interactive Brokers, and in doing so, you create a signal which you can opt into selling to our regulated entities and asset managers, in this case, FCA or EU. And we act as a central counterparty that buys the signals from all the producers. We also process the delivery versus payment. So you deliver your signals. We place the trades in the investor accounts because we are the asset manager. And then we collect the management fees and the success fees from the investors because we have the regulatory permission to do so. And then we pay out 75% of that to the machine learning or to the alpha producer, which means you get a platform, you get a hedge fund as a service at a variable cost of 25% of the fees you generate, in a nutshell. So, I mean, that's it. To wrap it up, it's survival of the fittest on both sides. It's really about producing the best strategies, we will direct index all of them. So we don't really do a selection as long as they can, they're eligible because of the assets they trade. We will always list them. And then the investors, be they retail or hedge funds, they invest in this so-called wrapper that we've created, this Darwin, which is meritocratic by design in the sense that anybody with an Interactive Brokers account can participate. The investors, the minimum tickets for investors are also deliberately low so that everybody can kind of test their feet before they really come in. An interesting point is that we process the end-to-end value chain, meaning we are the only intermediary. And that means the infrastructure costs are pooled with us and don't need to be borne by the producer, which means, there's cost savings. Also, because we are the operations department to all the producers, we have a far better operations department than anyone could afford. And last but not least, we are the only middleman between both parties. So we will be held accountable by, if this trader places a trade and it's not replicated on behalf of investors, this guy is going to get very angry and there's only one phone they need to call. Similarly, if something happens with a risk engine and there's like some account that blows up, there's only one number that the investors need to call. And that basically keeps the middleman on its toes, which means we're aligned by design, which means we have to be transparent by design, because otherwise we don't inspire trust. And also that we're compliant by design, in the sense that we're not riddled by any of the conflicts of interest that regulation is designed to preempt. So it's actually quite a clean setup from the standpoint of the regulators, as witnessed by the fact that we are approved by both the FCA, which is a high standard regulator, and EU regulation. So to finish off, it's always best to put a face to our name. So we see our clients in terms of where they are in the cycle of evolution. So one such customer, one such trader is, say, Martin. You can see Martin's track record here. He's now in his 4th year of delivering alpha. And we're now having the first conversations with professional investors to get this number of AUM to like the 4 or 5 million that we've already got others to. Another use case is family offices, or actually small asset managers, who choose to give up their regulatory permissions because they cost them too much, to actually centralize their activities with us. So, and this is one such case. So this is someone who's further down the road in terms of the AUM he's gathered. By the way, you can check out the payouts we've done to the managers. So for instance, this manager has received 210,000 euros of fees from us. So it's actually very transparent, showing what we do. And then we have upcoming partnerships with established managers who've worked with Bluecrest and a number of other like tier 1 places, who are now willing to distribute their strategies to us because they see us as a working and workable conduit to selling the strategies to retail investors without compromising the intellectual property, which is, of course, one of the most important worries. So, these kind of guys with high caliber. So to summarize, what do we do for producers? If you're someone who's starting out, well, we offer you a shot to show up in front of investors with a bare minimum of overheads in a way that you can show, if you've got it, you can do it. If you are an asset manager, we've got turnkey operations for you, which means you can save an awful lot of money and bandwidth into actually producing alpha. And if you're someone as a proven manager, then we offer a direct platform to tap into end investors with minimal overheads and infrastructure. From the standpoint of an investor, be that Bluecrest or some like tier 1 prop or investor, what we offer is a steady flow of aspiring managers who then graduate into emerging, who eventually become proven and then receive the allocations, because they stand on top of this natural selection process. Thus the whole term of Darwinex. And knowing that we deliver capacity on a first come first serve basis. So if you're the first guy to spot good emerging guys, then you can get your capacity filled before the rest of people trust them. The process is fully transparent. The process is trustworthy because there's an independent risk management engine, and then something happens which doesn't really happen with many hedge funds. In hedge funds, you've got the front office and the middle office reporting to the same CEO, whereas with us, you've got the front office on one end, and then the middle office reports to the platform, not to the front office. And then at all times, they have full control because these assets are liquid, so they can really buy into or out of strategies immediately. And that's it for me. I mean, feel free to share this. I mean, if there's something you can do to help us, is share this with anybody that you think might benefit from knowing the product. And if you have any questions, you can get in touch with us, and I'd be happy to even demo the platform if it's something that is of interest to you. So thank you, guys, for paying attention to this, and thank you, Gautier, for giving us the opportunity to pitch to such a smart audience.